Welcome back to Switzer on Australia's Business Channel. With 2013 being a strong year for equity markets, Paul Rickard, former Managing Director at CommSec and co-founder of the Switzer Super Report, is here to explain how his portfolios outperformed last year. Paul, welcome to the show.
Thanks, Marty. Good to see you.
Great to see you as well. So, regular viewers and readers of the Switzer Super Report would know that you constructed two portfolios in 2013, and the results have been fairly impressive. Can you firstly tell us what were the portfolios that you constructed?
Yeah, look, Marty, there are two portfolios. One's an income-oriented portfolio and the other one is a growth-style portfolio. Look, importantly, they're more examples of how to construct a portfolio rather than being, my definitive portfolio, but it was more about some of the rules that you might follow if you were looking to do this yourself, and also with a lot of, self-managed super fund investors wanting to do these things and wanting to own shares directly. This is sort of our guide about how you might approach it.
Yep. And as I mentioned before, the results have been good.
They've been really good this year, much better than I thought.
Very good indeed. So we've got a chart that actually shows the performance.
Yeah. So across the year, Marty, the ASX was up by 15.1%. If you add back in dividends, that took it to 20.1% on the chart in front of you. Our income portfolio, which I thought would probably underperform the market because it's fairly heavily weighted to the defensive stocks, that actually outperformed by about 4%. And the growth portfolio finished up at 27.5% for the year, an outperformance of 6.4%. So they're pretty good results, and I don't think we'll do it this year, but it was an exercise in demonstration about how you might go about it.
And the ASX 200 accumulation index is the index that includes dividends.
That's right. So everyone talks 15% for the market, but of course, one of the main reasons you invest in shares, or at least the reasons that we talk about with the Switzer Super Report, Trustees are about dividends, and that's why really you should look at the accumulation index. And again, the important thing to remember there, Marty, is that that's also pre-tax. So, of course, in both these portfolios, we have a bias towards fully franked dividends, and for people running their own super fund or people at home, the benefit of those franking credits is so important.
Yep. So to recap, ASX 200 did 15.1%, the accumulation index did 20.1%. The income portfolio did 24.3%, that's the Switzer income portfolio, and the growth portfolio did 27.5%. Paul, how did those returns compare to, say, an ETF on the following the ASX 200 or one of the leading balanced managed funds? Okay,
so I looked today at the ETF. The ETFs which will track the index. So the largest ETF in Australia is from the Street Tracks Index, code SPDR. That returned, I think, 19.7%, which is what you'd expect. Just below the accumulation index, they have a few fees and there's a few costs, so it'll do a little bit under it. The sort of managed fund returns aren't out yet, and they'll depend on the style of portfolio, but I'm guessing that the really good funds will do around about that level, but the average would probably be more like about 18 or 19% because of their management fees.
Okay. So we've got another chart that we're going to put up that's actually going to, you're going to take us through your process for how you constructed both these portfolios.
Yeah, I think that's probably the most important part of why we do this. So really where we start is with a top-down view, which is actually we look at the different sectors. So the market's got 11 major sectors. Obviously financials, which are the major banks, materials, which are companies like BHP and Rio, consumer discretionary and the other sectors that make up the market. And you really need to take a view about which of those sectors suits, your sort of style of investing, whether you're more after income or potentially after growth, and also what you think is going to do. So it's a top-down view starting with the sectors.
Yep.
And of course, in sort of creating the income portfolio, which are the rules here, we have sort of take biases that favour the high yield, lower price earnings sectors, so the ones that are sometimes called the more defensive sectors, which should produce more income rather than growth.
Financials, staples.
Consumer staples, those type of sectors. We put some rules on it. Now the next rule is sort of my rule. It could be whatever rule you want, but to make sure you get some sort of reasonable tracking with the overall market, we make sure that the bias is not more than 33% away from what the sector weight should be. So, for example,
we're talking the income portfolio right now.
Yeah. So, for example, material sector is currently about 17% of the market. So, if you were to set up this portfolio today with that rule, that would mean that you could deviate by plus or minus 33%. So you could end up with a range in your portfolio from about 12% to 24%, if that makes sense. A third of 17 is about 6. You could be as low as 12 and as high as 24. So in the major sectors, we've got a rule that sort of makes sure we're not too far away from, don't take too much risk. Then 15 to 20 stocks. Why 15 and not 30 and so forth? By and large, yeah, look, 10 stocks is probably not enough. We're really going to get the diversification. Once it gets more than about 20 stocks, it's pretty hard to keep track of. You just, as an investor, and for you, Marty, as well, don't have time to know what's going on in every stock in the market.
Yep.
There are some stocks or some industries we don't like where there's a lot of risk, and things like insurance and airlines are industries that you can't control. So I just don't touch stocks in a couple of industries. Broadly, then, we look at the stocks inside the index, which we weight back to the index. And, of course, you look for a track record of companies that have good management, consistent earnings, and are hopefully paying fully franked dividends.
Okay. And what about the growth portfolio?
Growth portfolio is a little different. Some of the same rules, but obviously the bias there is towards those sectors that we expect are going to grow, have higher PEs potentially because the market is already factoring that in or putting them on an earnings premium. And again, still some rules to try to get some sort of overall balance, but obviously the orientation is a bit different. And so you'd expect to see in that portfolio less income, more growth, and of course the stocks will generally probably be at a higher PE than they would be in an income portfolio.
Okay, and so how will you be investing in the year ahead?
I think this year's 2014 is going to be a little different from 2013. I very much agree with James and the point he made around looking for companies that have exposure to the US dollar, essentially. Yep. Because I think, the Aussie dollar, even at 89 cents, at some stage this year we'll see 80 cents.
That's the call?
That's my call.
80 cents?
Yeah, and I think that as much because that's where the Reserve Bank wants it to go. They've talked 85, they'd probably be happy a bit lower, and so they're going to do everything they can to get it there. So, and I think we're also in an environment where there's globally this swing back to the US dollar. So companies that should benefit from that. The other sort of big issue that we've got to look at is that last year we had such fantastic performance by the major banks and Telstra, which are the so-called yield sectors, which have done so well. Now that probably is not something you'd expect to carry on to the same extent, although at the moment there aren't really a lot of alternatives. So I think this year you've got to look to rebalance a little bit away from some of these so-called yield sectors and have a slightly higher approach to some of the cyclical stocks.
Okay. Who are these portfolios designed for?
We obviously, because they're coming out of the Switzer Super Report, we look at self-managed super funds and clearly target their needs, and their needs are very much driven by their different tax rates, whether it's 15% in accumulation or it's 0% in pension. So there's obviously a bias towards thinking about the after-tax outcomes, which I think is how we always should think about investment returns. Look, if you were for a growth investor or for someone sitting at home who's paying tax at 46.5%, look, I think you've got to have a slightly different approach, and obviously, you look at a slightly different portfolio outcome, but these are very much focused for super fund investors.
A little bit off topic, but I guess all related. What's your view on the banks this year and how they'll perform?
I think the banks may have had their best days behind them, in front of them or behind them, if I've got that around the right way. Yep. But at the moment, they're still creating yields of 5.1, 5.3%. It's very hard to see that elsewhere. They're going to have some earnings growth, 2 or 3%. Bad debts are not yet going to be a problem. So you can almost, at the moment, I think, look at them as an annuity-type play. I wouldn't be selling bank shares by any means because I think if the market rallies, they're going to keep going up. But my guess is they won't go up at the same rate. So if the market in, say, 2014 goes up by, say, 15%, I think if we have this interview at the end of this year, I think we might see an increase in bank share prices by, say, about 10%. With dividends, be pretty good. Yep. But I don't think
the SMSF Army is not going to abandon
the SMSF Army is not going to abandon bank shares at any time soon. I would just suggest to people out there that maybe if you don't want to de-weight, at least with new cash, because one of the things that most funds have is new contributions or earnings, they've got to keep reinvesting, is that they can change their weighting either by just looking outside those sectors and taking a little more exposure to companies with potentially, US dollar earnings, or the Aussie dollar, or conversely something that might benefit from a pickup in the Australian economy.
Regional banks, there's a couple of them. Bank of Queensland had a great year last year. Can you see similar growth?
Yeah, look, I think the
continuing?
year to buy regional banks might have been last year. Bank of Queensland was up by more than 60%. I think it was probably 64%, the best performing stock in the index, or close to it. Suncorp did pretty well. I've swung out of regional banks back into the major banks. I think they've had their year of recovery. I think where we're seeing just a little more risk as prices become more expensive, and with other things happening, recapitalisation occurring, I'm probably more inclined to think about the major banks as opposed to the regional banks.
And you were very right on NAB last year. Is there going to be a rotation policy this year?
Rotation back into Commonwealth Bank, mainly because the Commonwealth Bank does trade at a premium to NAB, but NAB got pretty cheap last year. It's still out and away the best bank in Australia. It's the most expensive bank, but it enjoys its premium rating. And I think you can probably have exposure to all the banks, but I would favour the Sydney-based banks over the Melbourne head office banks. Okay, great. Look, just as before we wrap up, if you want to access the portfolio, you go to the Switzer Super Report website? Yeah, switzersuperreport.com.au. Excellent. And it'll be our new income portfolio, slightly adjusted. Will be there from Monday, and our readers, subscribers will get that. Be there from Monday. Be there from Monday. Thank you very much, Paul. It's time for another short break, but when we return, Dominic Carosa will tell us why you should start investing in technology stocks.